So good morning, everyone. I'm Laura Levanier, your CalTRUST Chief Executive Officer. Thank you for joining us today for our market update and discussion webinar. We have our wonderful team from State Street Global Advisors with us today, Simona Makuta, who's our senior economist, and Will Goldthwaite, who's portfolio strategist. As you know, State Street Global Advisors is our asset management team, so it's always a treat to have them with us for our discussions. Please make this interactive. Use the chat box, which I will make sure is enabled this time, because it's probably not, knowing me, and the Q&A to get involved, ask questions, and, let us know your thoughts. We'd like this to be as interactive as possible. We'll allow time for questions, so please make this your webinar and what you would like it to be. We will have a recording of this available later down the line. So without further ado, I am going to go ahead and pass it off to Will to get us started on our discussion. And first, he has to read our disclaimer. So we're going to bear with him for a minute while we get through the legalese.
Yep, exactly. Thank you, Laura. Great to be here with you all. But yes, I do. So before we get started, I must let you know the information on this webinar is intended for the confidential use of clients and prospects of CalTRUST. It's not open to the press. Any review, dissemination, distribution, or copying of the webinar material is strictly prohibited without the permission of State Street and CalTRUST. And comments made by the speakers are their opinions and not reflective of their firms, State Street or CalTRUST. The comments do not constitute investment advice or analytical research and should not be relied upon as such. And also with that said, I must note that we are recording this webinar on May 9th, 2025 at 10 a.m. Pacific time. So as we chatted just before this call got started, sometimes you have to put the time as well as the day because the news flow is moving so quickly. So with that said, Simona, I made a bit of a boo-boo when I distributed my Q&A, Laura and my Q&A, in not recognizing that you had made an adjustment to your forecast on the heels or maybe just before the Fed meeting on Wednesday. So you've now moved your call on the first ease. So maybe talk to us a little bit about sort of obviously Chair Powell was almost as clear as a chairman could be in the press conference, but definitely implied that he would not be, or they were not considering cutting rates. So at the June meeting. So what were your sort of key takeaways from that meeting?
And honestly, I felt torn about moving the first cut from June to July. It was not so much because of the data, but rather the tone from the Fed and this obvious attitude that things are so complicated, things are so confusing. We can afford to wait, therefore we'll probably wait, right? It's very much bringing back memories from last summer when we were in the same place. On one hand, here I was arguing they should start cutting, like please start beginning the summertime, and they did not. And then we got a 50 basis point move in September. I am not looking at that, pace or approach as the baseline scenario right now, but I would not be shocked to find that there is so much hesitancy around tariff uncertainty. And, until you see that you get the trade deals done and you're avoiding another tariff wave, when the 90 days are over, that you just, continue to push the cuts backwards. But I think the economy both needs and should get the little calibration of lowering rates. So for now, it's July, September, December. We are not changing the 3 cuts for the year call. That's the part where the conviction is higher. The timing is a little cloudy as the weather outside. At least here
Yeah.
in Boston, I should say.
Yeah. No, it is. It's sort of a dreary day in Boston, and very much sort of matching what it appears as though is going on in the economy. And I think that's the part that I'm totally with you on. And I do think back on what happened in 2024 and just how the Fed currently, with their funds rate at 4.25, 4.5, that is restrictive. And so are we, I guess maybe I'd appreciate your thoughts on sort of this linear move that we've seen in post the highs of inflation and the tightness in labor. And we've seen very much a linear move where we are gradually moving, and there's some bumps along the way, but we're gradually moving towards a lower inflationary environment. And I think that fits with our the long-term secular trend. So all of the anecdotes I'm hearing now, and granted they're anecdotes, granted it's survey data, and I know everyone's got, taking a what did you call it, a bucket full of salt with some of this survey data.
Well,
So
I am for sure.
yeah,
A a
uh,
boulder of salt, not
a
just a grain.
boulder. Yes, that's right. That's right. That was well said. So yeah, so just thoughts on sort of the idea of disrupting, inflation pushing higher. It just doesn't seem like that's in the news flow.
Well, I guess it depends how you look at it. I think it's all over the news flow. I think that all the stories are about upside risk to inflation, which is very ironic because, on core PC, the last number we have, we printed 2.6% year on year. That was the twin lowest since the whole COVID inflation, episode began. So you're clearly improving. On headline PC, I think next month will be literally a hairbreadth away from hitting the 2% target. And in this environment, still the Fed is very cautious and very anxious about lowering rates because you don't know what the transmission mechanism from tariffs is. Actually, you don't know what the tariffs will be. I think that actually Chair Powell did a very good job at the press conference emphasizing simply the reality that we don't know. We have not experienced this kind of tariff shock in the past. You don't know what you're gonna get. You don't know what their duration will be, and you really don't know. You're speculating at what the transmission mechanism will be. Our view all along has been that you come back to the basics and you say, if the consumer wallet does not expand, and you have a price increase in a portion of the economy in the traded goods segment, something else has to give. Whether it's less demand and therefore disinflationary pressures in parts of services. Just today I was reading, I won't name names just in case, we should not name companies, but, food chain saying we are seeing a dramatic decline in orders since April. Um, there is a big impact on relative prices within the economy. I think what remains to be seen, what is the impact on overall prices? And while tariffs are happening, oil prices have dropped. We still have disinflationary forces in the housing segment. That craze of COVID, everybody overbidding and the 20% rent increase, that's over, and supply is increasing, rental vacancy is increasing. So I think I take a little bit of heart from seeing those forces permeate, and I think the trajectory really is towards the target, not away from it in a sustained, meaningful way.
Yeah, I guess I should have been a little clearer with my comments, because what I see with some of this inflation pressure is demand destruction, rather than demand continuing on the way
Mm-hmm.
it did in 21 and 22. I mean, I met with this past week. I was on the road. I met with a large automobile manufacturer, and they were talking about the hit that they're anticipating, just given the fact that they have certain parts and components that cross the border with Canada maybe 2 or 3 times. I also met with a shoe company, a distributor, and they were saying that the back to school season seems fine, and that they've done enough warehousing for that they should be able to meet that demand. But they're very worried about the Christmas season,
Christmas season.
and that's going to take a long time for that to feed through into the numbers. So I guess that is the thing that you wonder about a little bit. And again, I'm thinking back to your call last year, sort of thinking that the Fed should have been in front of it, and then Chair Powell at the press conference saying that we haven't seen it in the data, we haven't seen it in the data. So the worry, I guess, is that by the time they see it in the data, I mean, do you think that they're just going to have to accelerate similar to what they did last September?
Well, I think it all, yes, I think if you're starting to see the 2 points I would make. So there were the differences from between now and last year was that last year they were starting from 5.5 Fed funds, right? So you're further away from neutral. You actually had, more scope to cut. Now you say you're 100 basis points less restrictive. He said that time and again, right? On the other hand, last year, you were not yet on the labor side where at a balance point. And the pressures were still that the labor market's tight, still excess labor demand relative to the number of unemployed. Now you're in per like it's amazing that chart that shows number of unemployed versus number of job openings. It now sits on those two sit on top of each other. So you've cut and you're not as far from neutral on the Fed funds rate, but you're also already at neutral on the labor market. So every, 10 percentage point increase in the unemployment rate now takes you away from that part of your dual mandate. And you brought something up that I forgot to mention in the list of many unknowns. The first quarter GDP was an extraordinary story of anomalies and distortions. The surge in imports was extraordinary. In terms of goods imports, I mean, just contemplate this number, 50% seasonally adjusted annualized. And what's also fascinating, so we've only seen this once during COVID. It was only bested after the reopening began. Now, during COVID, you had also that extreme stress on the supply chain. Whether it was the supply itself, the ports, the transportation. Right now, I'm looking at the port of LA, the wait time for ships in the port, like zero sign of stress, delay whatsoever. So you have to also envision a scenario where, okay, now you brought in all these imports. What if you actually avoid a tariff wall in a couple of months' time? Then you no longer have the need to continue with the import preemptive ordering, and you could actually have a relapse, right? So you could have actually a demand bubble later in the year. So it's just so complicated. I do not envy anybody who is a procurement manager right now. I say it's hard to forecast, but I feel like it's in a way almost easier to forecast the macro environment than the individual stories. But it's too many things moving, and I think you come back to the basics. The labor market, now you have to worry about two-sided risk. Inflation, even in the worst case, it's still a transitory shock. And, do we think we really stick to 145% tariffs on China? I personally do not. It's now a story of how do you de-escalate?
Yeah, exactly. How do you de-escalate and how do you make it look as though you won? Which I know the current president is
That's
very
important.
interested. Yes, it's very
Yes.
interesting. He's very interested in making sure that he can appear as though he won. And I saw a quick headline that said, he was sort of commenting that 80% tariff on China seems like the right number. I don't know where that came from and whether it's true or not, but I just saw it flash across my screen. So I guess going back to the labor market, I look at that same chart and it's interesting job openings, and I am hearing more from the companies that I'm out talking to that are talking about, a soft freeze or oh we're delaying hiring, not sure whether we should continue with this hiring. At the same time, we know that immigration the flow of immigrants has changed, and that is it possible that some of our low unemployment data is because the supply of immigrants, or is it just too soon to know that in the data? That was one thing that I thought was interesting. In other words, are we constraining the supply, so therefore the growth prospect is slowing, but we're just not seeing it in unemployment? Is that anything that's reasonable to think about?
I think it's absolutely reasonable to think about. I doubt it's a story that's already showing in the number, but as a trend, it's actually been part of our story that, labor demand is slowing. So in that context, the reduction in labor supply actually prevents the unemployment rate from going high, right? Which is, you know, uh, it may also, depending on how, it could prevent the Fed from cutting early, because to the extent that the last few months have been steady, up and down around 4.2%, that's not anything calling on the Fed to act with urgency. There was an interesting question in the press conference the other day where I think Chair Powell was asked, like, how will you decide, when will you know which of the patients needs urgent care? And the reality is, no patient needs urgent care. Right. If you're talking urgent care on inflation, you'd be talking rate hikes. I don't think that's on the plate. I think the options really are about holding steady, so steady for longer versus daring to cut. The labor market, you're watching, but certainly, even if it goes up 4.5, you'd say, okay, this is becoming requires monitoring, but it doesn't necessarily scare you altogether. I don't think we get to 4.5% very quickly. Part of it is what's interesting is also this idea of contagion, and it works both in the labor market and on inflation. So in the labor market, if you look at layoffs, you had a big spike, but it's been very, very heavily concentrated in the federal government, obviously because of DOGE, right? Nothing of the sort has ever happened with federal government. Even if you go back to whether it's COVID, what DOGE did in a couple of months made COVID pale in comparison in the government sector specifically. That has not yet translated to the rest of the economy in the private sector. That's what I'm watching. Is this deepening? Is this broadening? So far, no, because it makes sense. You've been struggling to find workers. Unless you're sure you no longer need them, you're not going to rush to lay them off. So it's a matter of timing. You need to get relief on tariffs so that the diffusion elsewhere in the economy doesn't happen. And it's the same with prices. I was actually on a client webinar this morning, and we have the price stats data that some of the audience may be aware of. There are portions of the online basket that you see price increases, furniture, home furniture, furnishings, for instance, but there is no evidence of broad diffusion. So I think you're still into a little bit in this holding pattern where everybody's waiting to see. The pricing power is not what it was in 2022. Let's be clear about that. So, I think there is no evidence that other companies who are not impacted by tariffs are taking advantage and raising prices just because they can, because I think the sense is we can't really.
Yeah, that sort of leads into that question around greedflation, right? And we know that there were certain industries that were perhaps being a little bit more aggressive with their price increases just because they felt as though they could. And now that it's going to be difficult to do that again against a stretched consumer, right? We know that credit card delinquencies are up. We know that the labor market is more fragile. Just talking to a couple of friends that are out looking for work, they're getting a lot more of like, oh no, that position's been frozen. Or it's been a pushback. But as far as consumer strength, I know that you recognize the savings rate. They had sort of that one-time adjustment, and talking a little bit about the consumer, because I know this audience is very interested in sales tax revenue. That's a big line item for Californians. And so with that stress within the consumer and with them still being employed, I guess that's the thing that we always think about is like the consumer's strong as long as they've got a job. It's once they lose that job, that's when their spending habits really change. But do they have, like you've already talked a little bit about it, so I guess maybe I'm just asking the question again, but how much further can this consumer go?
So our expectation is that consumer spending slows. And that would have happened almost irrespective of tariffs. Now, tariffs accentuate that. It doesn't contract, however. And what's ironic, again, going back to some of the distortive effects that tariffs have, January, February, no tariffs, motor vehicle sales were like about 15 million something annualized rate. March, tariffs approach, motor vehicle sales 17.8 million annualized. April, so you actually have almost this counterintuitive effect where you bring forward some consumption.
Yeah.
So I think that softness again is going to become visible just over time. Consumer spending year on year on goods in Q1 was 3.8% year on year. That's extremely strong. From here, it's only going downhill. Well, maybe downhill is too scary a description, but only moving lower. However, for the year as a whole, you end up with a decent plus 2% number, which is why our GDP forecast is a little above consensus still. So we are a little more on the optimistic side. I think fundamentally, all the things you brought up are valid. They continue to unfold. They do not dramatically intensify unless layoffs take off.
Yeah.
And again, layoffs won't take off until people lose hope on tariffs or it's so stretched out that you say, I can no longer absorb this and I need to now make adjustments. I think we still have 2-3 months until we get to that point, and hopefully that's sort of the deadline for the negotiations, or at least the avoidance of the 90-day tariff threat. So let's see what happens. Hopefully we have more of these calls in between. We can adjust our views. But as of now, this is my thinking.
Yeah, no, and it makes perfect sense, and also you can appreciate why Chair Powell is saying that there's still a lot of data to get through, and those conversations I was having with the automobile company and then the consumer products company were speculative, right? The numbers hadn't hit the balance sheet just yet, so that does make sense. Okay, so if we just zoom out for a minute and think about the global economy and because we are the world is getting smaller and things are interrelated. I just want to just get a little bit of your view on this whole idea of like someone was saying that the manufacturer, the exporter, is at a greater risk than the importer, in a tariff war. You've made the point around the U.S. being a relatively closed economy with only, I think you said 14% GDP being imports. How is your thinking on that as far as how this might play out globally? And then does that further hurt the U.S. or help the U.S. in any manner?
So another way to think about that, I would say I agree. And the reason I agree is that I think in this world, supply is more readily available than demand. So the side who loses the supply has an easier time replacing it than the side that loses the demand. That also gives me perhaps a little more positive view of how trade negotiations end up working for the US. I have no doubt will incur some of the costs, but if you're looking at the UK deal, on average, US, tariffs on US exports to the UK face lower tariffs than before the deal. And the opposite is true for the UK. So the US actually has obtained a concession. It has expanded markets. The other question is how much of what what these imports constitute. I would say the big, really critical elements, I mean, I was probably with half the country, alongside with half the country. I have half the audience here today. I was also going to Costco and I purchased a TV just before the weekend. And this was not simply I needed a TV, but I had been dragging my feet to go buy it. And I was like, well, better do it before the tariffs hit. And then, of course, tariffs, flat screen TV are excluded, right? Automotives, there are tariffs, but there are also, carve outs. So um, for many other things, I think you can either substitute or simply delay.
Yeah.
Meanwhile, the party that produces the good has idle workers. And that's, I think, a more serious challenge. And I think perhaps a little bit more of an incentive to get to the table and make concessions. I'm sure that's what the US administration is counting on. We'll have to see how it works out in practice, but I would generally agree with that viewpoint.
Yeah, that is interesting. And we already know that China has been pushing their excess capacity on other countries in the world. I mean, we've read those stories. Um, and that brings you back to the other thing that we talked about when we were talking about tariffs. Just this whole idea of cheating, and moving a product through another country to avoid a tariff. And this is something that I guess has been a thing forever, for perhaps as long as there have been tariffs, bilateral tariffs. So I wouldn't suspect that it will be any different this time. Like, is that just unavoidable? Like, are we going to
Well,
continue to? Yes, sorry, go ahead.
I would say that very questions, and I'm glad you asked it. And now, hopefully soon my next blog piece will be available for your enjoyment. But it's, I think that is why you've also seen the sort of tariffs that were announced on April 2nd, because there was a lot of consternation about the level, but also the idea that, countries that are both allies and maybe small emerging markets, why are they targeted? So the piece I wrote also highlights this not just about bilateral trade deficits, it's also very much about currency manipulation concerns. And there are significant concerns and mostly about otherwise allied or friendly countries. There are also concerns about countries like Vietnam, which I think not everyone recognizes has gained incredible market share in the US. We almost import as much from Vietnam today as we do from Japan. This may come as a surprise to many. And that's when you look at which companies are driving this, it's actually foreign direct investment into Vietnam that's driving those exports. So the idea that this is used as a alternative source, but by other countries who may, seek to avoid direct tariffs is not without merit. So there is, despite the apparent, chaotic approach, I think there are actually core points that the US is trying to address by making these tariffs as broad as they've been announced. And I hope those are the kind of things you actually hope to get resolution around currency policy, around, sticking by the rules that on paper are there, but in practice may not be followed. To the extent that you tighten the system, that would be a win, I believe.
Yeah, so what is the path forward? If a tariff can simply be implemented through executive order, what's the path? What's the longevity of this going forward? Is this something that you think the current administration will try to legislate so that they can somehow incorporate these as new trade practices? Do you think this becomes the trend amongst trade? I mean, certainly we know what the trend was prior to this, right? It was easier trade, lower tariffs, lower, cost to trade, the globalization, that is all seemingly going the other way with April 2nd announcements. Do you think that there's a way that this administration can put these tariffs into place so they're harder to change, or is this just something that each administration is going to be able to do what they want with them?
Yeah, this part of it, the way it's done, meaning not legislated by via administration, is the part that actually is the most problematic because it introduces an element of inconsistency,
Yeah.
which undermines the effectiveness of, and not just on tariffs, but on many other things that are being done by executive. You would rather do them in a more systematic, lasting way. I think it remains to be seen. You need Congress to reassert, to show interest and reassert authority on some of these topics. I think for the time being, they are being done by executive tariffs, and I think what you wait to see is what concessions you get via, threatening and imposing very high coercive, deploying these coercive tactics. So, and to what extent they get rolled back. I don't think they get rolled back entirely. I think the best case scenario is you get some kind of a universal tariff in the range of 10%, higher tariffs on China. What exactly the level is, I'm not sure. Um, but at the same time, you would like to see genuine progress towards improving the efficiency of institutions. The reason it's done this way is also because a lot of these complaints that the US has voiced for many years have not been addressed. You do have the WTO, but highly ineffective. In fact, I was digging through some of my presentations from 2019, and I had a quote there from the European Commission talking about how, in theory, it should work via WTO, but in practice, it's really, the system is highly ineffective. And it's not gotten better in the last 5, 6 years. Ideally, that's how you would want to do it. But that takes a lot of effort and multilateral, genuine commitment. Sticking to the rules, um, you know, not just the letter, but also the intent,
Mm,
or what's that saying? The whole of the agreement,
yeah.
not just the appearance of the agreement.
Yeah. Yeah, and I think you raised the point about obviously dealing with so many different countries, the complexity of trade, and having trade agreements, ripe for cheating, ripe for making the rules work in your favor. I think the part that I don't know, encouraged maybe is the wrong word, but the part that I'm interested in seeing how this plays out is just that the changes are so dramatic and they're so disruptive, that like we wonder. You made a comment in one of your previous pieces that I read that just that the current path was unsustainable. And I think
Absolutely.
that's, he's really shaking it up here, and what the outcome is. There's certainly plenty of people that are booing from the sidelines, but also not offering any alternative plan. And I think that's the part that's going to be most interesting in watching this develop. Um, so I think, from a portfolio perspective, the way we're positioning in the market, really, when the year started, and I know we've talked about this on previous webinars, but when the year started, we were really thinking there could be a whole number of outcomes. One of those outcomes was a reacceleration. And how quickly the market changed over the course of 2 or 3 months, and now how the money market curve has reinverted, Fed funds 2-year notes inverted, the market definitely anticipating that the next ease, although delayed, the June ease, but definitely thinking that the next path, the next move that the Fed makes is a policy rate ease. And so we are positioning the fund around that. We're trying to keep the duration of the liquidity pool a little bit longer. On April 2nd and the weeks that followed, we definitely saw credit spread widening. We saw vol increase. And so we were happy with the positions that we had on in the short term and medium term funds where we were cautious on credit. Really not trying to pull on that lever as hard as we might in a growth environment or in a neutral environment. So, getting back to sort of the top of the call, when we think about the path of the economy, if we do think it's linear, although with bumps, but moving more towards slower growth, perhaps a labor force that's more in balance, perhaps prices trending towards that 2%, although there could be definitely disruptions as we get there, then it would make sense for us to be cautious on credit. And then leaning in on the duration. So the short-term, medium-term fund definitely long their duration benchmarks, with the expectations that treasuries will outperform, and that position has worked well in the fund. And we've been able to lock in some of those higher yields, and so preserving some of that current income that we know investors are looking for. So I think from an overall technical standpoint, we'll continue to watch debt ceiling as the debt ceiling starts to unfold later this summer. My personal view is that President Trump has no interest in really a protracted, series of events there. I think some of the more vocal deficit hawks, well, one in particular has left the House, so won't be as disruptive. And then I think President Trump will be able to keep the others in line. So I'm not anticipating, my personal view is I'm not anticipating a lot of disruption around debt ceiling, but we're also keeping a very close eye on the rebuilding of the Treasury's general account. That's their checking account that they pay all their bills from. That's going to definitely pull some money out of the system, and it's also going to cause Treasury bill supply to increase, which is a seasonal thing. Obviously, with about $250 billion going into the Treasury's checking account on April 15th, we do see a pay down in bill supply through the late spring and into the summer. And then we would expect that to increase as well. And we would anticipate that, we'll be buyers of those bills when they come because they usually offer really good value. And then lastly, I would just say, from a quantitative tightening standpoint, the reduction that the Fed made, at the March meeting is just telling us that they really want that to run quietly in the background. They do want their balance sheet to be smaller. They want to own fewer treasuries, fewer mortgages. They don't want to own any mortgages. So we would expect that they want that to just run slowly and quietly in the background. So Laura, why don't I pause there? We've been chatting for a little while. I'll see if there's any questions that have come in, or if any questions had been previously submitted.
Yeah, let me just remind folks, please use the chat or the Q&A to ask any questions that you might have. I have not seen much come through yet that hasn't been addressed. So we're just gonna give that a second. And I think basically everything I'd seen you guys talked about already. It's a really wild time right now. So pretty interesting.
I'll leave you with maybe an anecdote. So I was, on this idea that somehow tariffs, because they are initiated by the US, it impacts our inflation more, right? But it's not just a US problem. I was in Europe for vacation, and one of our tour guides one point said 95% of my customers are from the US. I was in Rome, you could not throw a pebble and not hit an American, it seemed. So I think it's this whole reassessment of the, because people started the year so overweight US and underweight other regions, but the sentiment has dramatically changed. And I think, let's keep everything in perspective. This is, the US still is a much faster growing economy, higher potential rate. And everybody is seeking the US consumer, which that takes me back to, that gives you some power in negotiations.
Yeah, no, absolutely.
Yeah, it is interesting. The tourism industry is going to be very interesting to watch this summer. And I've heard anecdotes of people of non-US folks canceling their US vacations. Some hostility towards US going to other, I don't know if that's true or not. Yeah.
And maybe
so
if the US customer
tourism
tightens their
certain,
belts,
I know certain parts. Yeah. And there's certain regions in California I know that really rely on that tourism aspect. So it's going to be a very interesting. This gets us back to like the survey data, right? And whether people's survey responses are going to be matched by their behavior. And I think that's the billion, million, $1 trillion question for the summer travel season.
One metric that Simona mentioned earlier was the ports, the LA ports, and that's always a fascinating thing to look at is the port traffic and the rail traffic. I can't remember what site it is off the top of my head. I apologize, but there is some website that kind of aggregates that all that I've seen other economists touch on in a presentation. It's always fascinating because you think, oh, things are slowing, and it's like, no, here's the actuality, or vice versa.
Mm-hmm.
It's really interesting data to look at when it comes down to it. The other thing I thought was really interesting today that I didn't realize was when you mentioned that Vietnam imports almost equal Japan. I
Yeah.
never, I never would have, put that together. So that was really interesting to me, and just the concept that supply is more readily available than demand. Like I think that little tidbit sums up a lot. So I think this has been really interesting. Someone's asking me what's that website, the aggregated port data. I will try to find it and send it out to everyone after this. I know, I actually believe it was a presenter from, I want to say UPS one time that I saw present that information.
I would imagine they would have good data on that.
Yeah, I was going to
Yeah,
say.
yeah,
So,
yes, but I will try to find that and I'll dig deep and see if I can get that out to everyone soon. It was really fascinating. Um, so with that, I think we have no other questions or comments coming through. Will and Simona, I really appreciate your time. It's always so wonderful to hear from you guys, and I hope we are able to schedule a lot more of these moving forward because we are in such a rapidly changing time. I always feel like if I miss the news for a couple of days, normally I go back and kind of catch up on my week. And now I'm like, I don't know if there's any point on catching up on my week because this is all different in 24 hours. So.
So true.
It's super
yeah.
fascinating times we're living in. Like I said before, a copy of this recording will be posted on our website in the next week or so. And if anyone wants to have any further discussion or thinks of anything, please feel free to reach out to me directly. We're happy to facilitate further conversation. My email is Laura, Laura at caltrust.org. I try to keep it simple, and we're always here for you. So with that, happy Friday, everyone. Thank you again for spending part of your day with us, and I look forward to speaking with everyone next time. Have a great day. Thanks.
Thank
Thanks.
you.
See you later. Bye.
Bye-bye.